Today I'm going to share how to start investing for beginners in Germany. First and foremost, there's no limitations to anyone as long as they are investing their own money. Does not matter if you're on blue card, student visa, PR or spouse visa. As long as you're investing your own money, you do not need any permission from the Ausländerbehörde or the finance arm. So why should you invest right now? I'm sure you're watching this video because you're motivated to start investing, but it is your hard-earned money that we're talking about. So why should you invest right now? Well, the first thing is the high inflation, and investing in the stock market can be a hedge against this high inflation. So if you invest in the stock market, you are essentially hedging against this inflation. The next point is that there is a potential to earn money in the stock market. As an average, there is an annual rate of return of 7%. Obviously, there are different kinds of fluctuations in the market. Some years the return is very high. It can go as high as 30% or more. Some years the return is very low. It can go even in negative. That is why the average is about 7% in long-term investing. Then if you are investing in dividend stocks, you can also earn a passive income, as the companies that you're investing in give you a small dividend on a monthly, quarterly or a yearly basis. So this can be a really good way to earn passive income. Planning phase. Here we need to assess many things before we can start investing. So the first thing is that we need to assess our time horizon. It all depends on how much time you are willing to spend in the market. Is it 1 year, 5 years, 10 years, 20 years, 60 years? Depends on how much time you want to spend in the market. So once you set up your time horizon, then you need to figure out, do you have an emergency fund? Now this emergency fund is 3 to 6 months of your expenses that you need to save in a very liquid asset. For most, this can be cash saved in a separate account, which you always keep separate from your main account, and you only touch this amount when you are in an emergency. So buying a new phone is not an emergency, and buying a car is also not an emergency. But if you are having difficulties, if you are having financial issues or your car broke down, there are things that are not in your control, maybe you lose your job, this emergency fund will help you out when you are in that kind of a situation. Next, are you a trader or an investor? There are big differences in being a trader or an investor. Investors think in the long term. However, traders on the other hand can be short-term traders that can do day trading, swing trading, or even like mid-term trading. So you need to figure out, are you an investor or a trader? Then we need to assess our risk-taking abilities. For some, a 10% loss is a really high risk. But for others, 50% might not be a big deal, as the investing time horizon is very large. 50% of risk might not be that high for them. So you need to figure out what kind of risk are you willing to take. Is a 10% loss really high risk for you? Is 50% high, or something in between? Think about your risk tolerance and always stick to what you have planned. Here we have an example of Amazon. On the top graph, you see that this stock has dropped about 19% in the past year. But if you expand the time horizon a little bit, in the past 5 years, the same stock has seen a raise of 183%. So if you had a very small time horizon, for example, you started in the month of January and you thought you had a time horizon of 6 months, then if you had invested in Amazon, you might be down 19 to 20% depending on when you sold. But if your time horizon was higher, for example, if you started in August 2017, you might be up 183% by now. Next is figuring out how to take a loss. Now, markets go up and down. Sometimes you need to take a loss, sometimes you need to take a profit. A big issue beginners face is that they panic very quickly because they have not assessed their time horizon, and they have also not taken into account how much risk they are willing to take. But if you have already taken into account your time horizon and your risk-taking abilities, you might not be that much scared from market fluctuations. So right now the market is going down, but it might not stay that for a long time. No one knows. That is why it is essential that you do not panic sell. So next we are going to talk about what is a stock. Well, a stock represents the ownership of a fraction of the issuing corporation. Units of stocks are called as shares, which entitles the owner to a small portion of the corporation's assets and profits equal to how much the stock they own. Now, the examples of stock would include Apple, Tesla, Amazon, and Google. Coming to ETFs, what are ETFs? An ETF is an exchange traded fund, and it is a basket of securities that trades on an exchange just like a stock does. Now, ETF can contain all kinds of investments. For example, stocks, commodities, bonds, US holdings, international holdings. It can be a very diverse mixture of various assets. Now, the examples of ETFs include the S&P 500, which tracks the S&P 500 index. It can be MSCI World, it can be an MSCI World Emerging Markets. Coming to phase number 2, which is the different brokerage accounts in Germany. You can open a stock brokerage account or a depot konto with a bank or the so-called neo-brokers. With banks, there are examples like Deutsche Bank or Postbank, where you can open your depot konto or your brokerage account. The issue with these banks is they generally have really high commissions, and some have certain requirements which most new beginners do not meet. However, with these neo-brokers, there are almost no commissions, and some of them have absolutely zero commissions altogether. There are a lot of options available, for example, Trade Republic, Scalable Capital, eToro, Trading 212, and many others. However, Scalable Capital and Trade Republic are German companies, and they handle your taxes automatically. For many, it can be a plus point, as these are handling your taxes automatically. But there are pros and cons with everything. In today's video, I'll talk about Scalable Capital and Trade Republic. As I said, both of these companies are German based, and there are a lot of similarities, but I'll talk about the differences. So the first one is Scalable Capital. It has both free and paid plans. It has more than 6,000 stocks and ETFs, and the trading time for Scalable Capital is from 8 a.m. in the morning and 10 p.m. at night. Right now, they only have bank deposits to add money to the securities account, but I think in the future they'll be adding new options in the near future. With Trade Republic, you have €1 per trade. So it does not matter how large the trading order is, there's always going to be €1 fee if you buy a stock from Trade Republic or sell it. One thing I need to mention, with both of these traders, there's always going to be some spread that is included in the price. So with Trade Republic, you have more than 7,500 stocks and ETFs. A great thing about Trade Republic is that you can trade from 7:30 in the morning till 11 p.m. at night. You can add funds to your account using a credit card, Google Pay, and bank deposit. Both of these companies constantly add new features and updates, so these numbers might not be the same when you are watching this video. Opening an account with Trade Republic and Scalable Capital is very easy. All you need to do is download their app. Once you use my links, you can download their app, either Scalable Capital or Trade Republic. To open an account with both of these companies, you need to be at least 18 years old, have your German identity card or your passport from your original country. Then you need address verification, meaning that you need to have an address that is present in Germany. You also need a German bank account to transfer your funds from your account to your securities account or your depot konto. Both of these companies need identity verification. Trade Republic uses Web ID, while Scalable Capital uses post-ident. Now you need to figure out which nationalities are accepted by both of these companies. I have a detailed comparison of both of these traders, and I've discussed which countries are accepted, all of the different features in a video here. If you're getting value from this video, I would really appreciate if you hit the like button. Now, phase number 3 is, are you an investor or a trader? In this phase, I will show you exactly how I do stock research. So whenever I do research for a stock, the first thing that I look at is the stock price. So what is the price of one share of that company at the moment? I also look at the 52-week price range, the highs and lows of the same company. Then I look at the trading volume, and that is the amount of shares that are being traded during a specific period of time. Next is the EPS, or the earnings per share. This can be defined as the company's net earnings or losses attributed to common shares per diluted share base. This includes all of the convertible securities, debt, options, and warrants. Next thing I look at is the PE ratio. Now this is the price to earning ratio, which is calculated by taking the latest closing price and dividing it by the most recent earnings per share number. Now this shows how much a company's future growth has been baked into its current price. The next thing I look at is the EBITDA. Now this is the earnings before interest, tax, depreciation, and amortization. Let's have a look at how I do stock research in a live example. I will look into Google or its parent company called as Alphabet. I use a website called Macro Trends to have a look at all of these aspects to research a stock. So the first thing we will look into is the stock price at the moment. Now, Google or Alphabet is trading at 111 euros at market closing. The all-time high for the last 52 week is $152 and the 52-week low is 102. So this stock is trading near its 52-week low at the moment. If we look at the 2 years performance, 5 years, it has seen a lot of growth in the past couple of years. As we can see, in 2015, this stock saw a growth of 44%, then 1%, then 35%, and in 2020 it saw 31.03% growth, and in 2021 there was an annual change of 65.17%, which is absolutely huge. Now in 2022 we see that there is a drop of 23.07%. This is not because of the company fundamentals changing, it's because of the macro situation in the market at the moment. Next we'll go into the profit revenue and see the revenue that it is generating at the moment. So we can see the quarterly growth for Google is growing steadily, and just 2 quarters are showing negative growth. Apart from that, everything is in green. Next, we will have a look at the EPS. So the quarter ending in June 30th, 2022, it was 1.21, which is an 11.03% decline year over year. However, in the last 12 months, it has been 5.38, which is an increase of 16.76%. Next, we can have a look at the EBITDA, and it has been growing steadily in the past couple of years. Everything is on the up and up. And the final thing that we're going to look at is the price ratios, or more specifically to the PE ratio. At the moment, Google or Alphabet is trading at 20.7, which is near the expensive range. But as I said, the PE ratio is not just the only factor that we look into. There are many factors. That being said, if you just purely look at the PE ratio, Google is just touching the more expensive side of a company. Next, we are going to discuss how I research ETFs. Now, there are many aspects we look into when we are searching or researching an ETF. So the first thing that we look into is what are the assets that are being tracked in the ETF. Is the ETF following an index, for example, the S&P 500, FTSE 100, any other index? Is it following a sector? For example, within the S&P 500, is it following the IT sector, the communication sector, or any other sector? Or is it following a commodity like gold or silver? Or is it a mixture of all of these things? The next thing that we look into is the total expense ratio. The TER, or the total expense ratio, is a percentage that indicates the annual running cost of an ETF. The total expense ratio has nothing to do with the cost that you pay to your broker for placing or executing orders. These are totally different maintenance costs for your ETFs. Another thing that I look into is which provider is giving us this ETF. Is it Xtrackers, iShares, Luxor, etc. And the last thing I look into when I research ETFs is the total assets. If the total assets within an ETF are high, there is higher probability that this ETF will continue to be offered from the provider. If the total assets are very small, I generally stay away from those ETFs. The only website that I use to track or follow different kinds of ETFs is called Just ETFs. So let's have a look at how I actually research different kinds of ETFs. So we go to Just ETFs and click on Search ETFs, and here we'll have a lot of different options. For example, all of the asset classes like equity, bonds, precious metals. But we simply go into Find ETFs, and I'll search for S&P 500 and select the first one. Here we'll have all of the information that is needed for us. So the ISIN number or the WKN number, which we need to put in our tracker to see if this ETF is what we are buying or not. Then we have the current price at the moment. Then we have the total expense ratio. Now this ETF has a total expense ratio of 0.07%, which is very good. Anything that is lower than 0.1% is good when it comes to ETF. However, there are certain ETFs that go 0.5% or even more than 1%. So please look into the total expense ratio, as it can cut into your profits when we're working with various ETFs. Then we have the other details, for example, the fund domicile, and we can also look at the fact sheet which is available here. So this ETF is being provided by iShares. We can look at the key facts, the total holdings, the sector breakdown, and many other things. An important thing that we can look into with this fact sheet is the total assets of the funds, which is about 60 billion when it comes to iShares S&P 500. Now this is not a small fund at all. Now that we know how to research stocks and ETFs, the next thing comes is timing the market. Timing the market means we are predicting when to buy a stock and when to sell it. Now this is mostly done by traders, and investors generally do not look into timing the market. So here is an example of timing the market versus time in the market. Someone invested $10,000 on 1st January 1980. If they had kept all of their $10,000 invested in the market, they would have increased their money to $708,000 by now. If someone was trying to time the market and they sold at a time they thought it was good and then bought into the market again, and in their strategy of timing the market, if they just missed 5 of the best days within those 40 years, their $10,000 would have grown to $458,000, which is a huge difference if they had just kept all of their money invested in the market. If they had just missed 50 of the best days in the past 40 years, their $10,000 would have increased to just $62,000. Just compare this amount to the $708,000 if they had just kept all of their money invested in the market. So it is very difficult to time the market, and that is why a large majority of investors lose money on an average. So for most of us, time in the market is better than timing the market. Next, I'll talk about an investing strategy that is called as dollar cost averaging. Now this strategy is amazing for beginners and seasoned investors. In this strategy, we invest consistently in the stock market. We define a specific time frame of investing and a specific amount that we consistently invest. For example, I am investing 450 euros every month on the second working day of the month. It does not matter if the market is going up or down, I am investing consistently. For example, I'm investing in a stock which has a stock value of 2.5 euros right now. I have invested a small amount. Then if it goes up to 5 euros, I've again invested a small amount, and it does not matter how the market is performing. I'm consistently investing in the market, and that is why in the long term I'm somewhat mitigating the fluctuations within the market. And if the trend is generally going upwards, all of my investments are having a general upwards trend. Next, we talk about taxes on stocks and ETFs. Taxes are only applicable when you realize your losses or your gains. When you sell your stock at a profit or a loss, only then will taxes be applicable. In Germany, if you sell at a profit, there is going to be a capital gains tax which is applied on that profit. Now, this tax is 25% plus Solidaritätszuschlag, which comes to about 26.75%. So for example, you bought a stock for 100 euros. Now you sold it after some time for 200 euros. The tax will be applied on the 100 euros profit, not the whole amount. So you will only pay 26.75 euros on the 100 euros profit. When it comes to taxes, in Germany, there is a tax-free profit or Freistellungsauftrag. This tax-free limit is to 1,000 euros for singles and 2,000 euros for couples. This tax limit is applicable on all capital gains. So any interest that you get from your bank, stock profit, rental income, etc., all of that will be included. So make sure that you know this. And within Trade Republic or Scalable Capital, there is an option for setting up this Freistellungsauftrag, which you just need to put in, and all of your profits will be taken into account, and only the profits that are higher than this Freistellungsauftrag will be taxed. Anything below that will not be taxed. So why do we really need to invest as early as possible? The answer to that is the compounding effect. Let's have a look at how the compounding effect works. To calculate the compounding effect, we use this website from the SEC, which is called as investor.gov. You can go to this website. I'll put a link in the description. Now here we provide some values so that we can calculate how the compounding effect will work for us. So in the initial investment, or the amount of money that we have already invested, so let's say you're investing today, you have no money invested in the stock market, so we're going to put in 0. The next thing that we need to put is the monthly contributions that we are willing to take. Let's start with a very small amount of 25 euros. So this calculator is in dollars. It does not matter, the calculation will remain same for euro or dollar. So let's say we put in $25 per month, and our investment time horizon is 10 years. So we are going to invest 25 euros per month for 10 years. We put in an annual interest rate, or the growth that we expect. According to the market average, there's going to be 7% growth annually. So we put in 7%, and then we calculate the compounding frequency, which is going to be annually. So we click on calculate, and we'll see in 10 years, if we invest 25 euros per month, our $3,000 will grow to 4,144. This amount is very small. Obviously, we're just investing $25, but the effect of compounding increases when we are invested for a longer time frame in the stock market. So let's increase our investment time horizon from 10 years to 40 years and calculate again. Now you can see that the growth is exponential after year number 20, and we see that the $12,000 that we invest grow to $60,000. This is obviously just $25 per month. With time, you might be able to increase this 25 euros to 100, 200, 300, 500, depending on how much you're earning and saving. Let's increase this amount to $100 per month and keep our investment time horizon to 40 years and calculate it again. Now you can see here that the $48,000 that you invested in 40 years will grow to $239,500. That is why investing as early as possible is the best thing that you can do. It does not matter how small or large amount you're investing right now. What matters is that you're consistently investing in the market and you're letting your money work for you. A very common question that I get asked often is, how much should I invest? Well, it all depends on many factors. First thing is, what is your income? Then what are your expenses? Do you need the money that you're thinking of investing in the short term? If yes, then please do not invest anything. If you have some money that you want to invest, which you are not going to need in the short term, first thing that you need to do is create an emergency fund. As I mentioned, this emergency fund should be at least 3 to 6 months of your expenses. Next, you need to figure out what is your time horizon. If your time horizon is small, your risk tolerance might be very small. But if your time horizon is long, you might be able to take higher risks, as you will have some time for your money to go back to its original value or increase in value if the market is not performing very well. And the next thing you need to figure out is the investing strategy that you're going to follow. Are you going to use the dollar cost average investing, or are you going to just randomly invest? And are you an investor or are you a trader? So it all depends on what you want to do. So here are some of the actionable steps that you can take in order to get started. The first thing would be to open a broker account. As I mentioned earlier, you can use my link if you want to support me. The second thing would be research stocks or ETFs, see the different kinds of stocks and ETFs, then set up a savings plan on Trade Republic or Scalable Capital. And then step number 4 would be keep learning and repeat the process. Learn more. If you have any questions whatsoever, please write them down in the comments below and I will try to answer them as soon as possible. I have individual videos on almost every topic that I've discussed today. In this video, I share exactly how I would start investing if I had to start from zero. So thanks for watching Black Wizard, and I'll see you in this video.